Hi, welcome to our second lesson on financing, and here we're going to be talking about loan types. First and foremost, we're going to talk about FHA, VA, and conventional loans very briefly. We'll be getting into these in much greater detail in another lesson. FHA is the Federal Housing Administration, and they insure loans on real property. VA is the Department of Veterans Affairs, and they guarantee loans to veterans. And conventional loans are defined very simply as any loan, any bank type loan or institutional loan that is not an FHA or a VA loan. And we'll be spending time talking about uninsured and insured conventional loans in another lesson. Now, a purchase money loan, also called a seller carryback loan. Sometimes sellers and buyers do the financing between themselves and don't use banks. So wherever the seller is carrying back or taking financing, where the buyer is making payments to the seller, this can be called a purchase money loan or a seller carryback. And a simple example would be, let's say that I had a property worth $500,000 and you had $200,000, and we agreed, since I didn't need the extra cash, that I would take your $200,000 as a down payment, and then you would execute a note and a mortgage to me where you would make payments to me over the next 5, 10, 20 years on that $300,000. And I would negotiate the terms of repayment that you would make to me. So I would give you the deed to the property typically, and then you would execute a note and mortgage in my favor, and you would make monthly payments to me. Now in the old days, not as much today, oftentimes there was already a first mortgage on the property, and the seller carried back a second. And I want to use that as an example here. So let's take a situation where we have a $200,000 sales price and a $100,000 existing first loan on the property. So you're the seller, let's say, and as the seller then you have an $80,000 equity in the property. That's another term you should know. Equity is the difference between the value of the property and the existing loan or loans on the property. So you have an $80,000 equity, and I come along and I want to buy the property, but I don't have $80,000 down to assume the first loan. And let's presume that I'm not going to go to the bank and get a brand new loan here, but I'm going to give you $50,000 down, and I'm going to assume or take over the payments on the first loan, and then I'm going to give you a $30,000 second position note and mortgage. Remember, you're the seller, I'm the buyer. In this circumstance, I would then typically make a payment to the first lender on that first loan of $120,000, and then I would pay you monthly payments on the $30,000. You may be asking, well, how do you as the seller know that I, the buyer, am making the payments on that first loan? Well, typically what's done is we set up an account servicing arrangement at an escrow company where I, the buyer, make the monthly payment on both loans to the escrow company, and then the escrow company sends the payment to the bank on the first and to you, the seller, on the second. So in this particular situation, I call this a simple second, where the buyer assumes the first loan and the seller carries back enough, the amount owed, $30,000 in this case, on the second loan. And the terms of the first loan have nothing to do with the terms of the second loan. Now that leads us to the next type of loan, which is called a wraparound loan. And here I'm not going to go into a tremendous amount of detail, but I wanted to use that example that we just looked at, but structure the financing a little bit differently. First of all, $200,000 is still the sales price, and I still have $50,000 as a down payment. And we're going to finance $150,000. Remember, in the previous example, there was a $120,000 first and a $30,000 second, so that was $150,000. But here, the structural difference is what we want to focus on. The way we're going to structure this is we enter into an agreement where I'm buying the property for $200,000, I give you $50,000 down, and the other $150,000 is handled by me executing a note and mortgage to you for the full $150,000 to you, the seller, and you remain liable for the first loan of $120,000 owed to the bank. Now, in that circumstance, then, the buyer owes the seller $150,000 and signs a note and mortgage for that amount, and the seller agrees to remain liable for the $120,000 owed to the bank on the first loan. Now, this is a structural difference, and for the purposes of keeping it simple and for the purposes of not going down any big rabbit hole, what I want you to remember, the key wording here is the seller will remain liable for the existing first loan. That's telltale. That tells you that they're talking about wraparound financing. So if you see a situation where it says the buyer takes over the first loan and gives the seller a loan for the portion above the first loan, that is simple seller carryback financing. That's the simple second. If it says, if a question said the seller is going to remain liable for the first loan, then that's an indication of wraparound financing. So what we have basically is we have this first loan around which is wrapped this larger loan. Now, wraparound financing is rather sophisticated, and most brokerage firms will not even allow their agents to structure wraparound financing in a transaction. Also, some people think wraparound financing will allow the buyer to avoid the due on sale clause, and it doesn't. So due on sale clauses, which we'll talk about in another lesson, are clearly enforceable, and wraparound financing, keep in mind, does not circumvent the due on sale clause. The next type of loan that we might see is an adjustable rate loan, or an ARM, an adjustable rate mortgage. This is where the interest rates will fluctuate over time as mortgage interest rates do fluctuate. They're quite common. Personally, I'm a believer in 30-year fixed rate financing. That way you know what you've got. But adjustable rate loans are quite common out there, and they can benefit borrowers in certain circumstances. The next is the graduated payment loan. The graduated payment loan steps up typically in the payment. This could be in a negotiated loan between a buyer and a seller. Years ago, remember we talked about negative amortization loans in another lesson? Well, the graduated payment process was also used in that negative amortization. So even though the loan balance was going up, the payments increased until such a time when the payments would be large enough to amortize that loan down to zero. The next one is called the blanket loan or blanket mortgage. And here we have these three adorable kids under a blanket, and those three kids represent three different properties, because a blanket loan is a loan that uses more than one property as collateral for that loan. Visualize a home builder who's building 100 homes in a subdivision. They're not going to get 100 separate loans on those homes. They're going to get one blanket loan which is secured with all 100 homes they're building. And as a home buyer comes along and buys each and every home, they will have those properties released from that blanket mortgage. So a blanket loan, blanket mortgage, a mortgage with more than one property as collateral. This next one is called a package loan. And just think of a surprise, a nice present. Your present might be a washer or a dryer or a refrigerator, because a package loan is a loan in which the loan includes items of personal property, typically with new homes, by the way, where the buyer can include the washer, the dryer, refrigerator, and maybe even some other items of personal property. Now, there's debate that goes on as to whether it's a good idea or not to do that. I'm a believer, assuming the interest rate is relatively low, this is my personal opinion, I'm a believer that it's probably a good idea to finance these things in, because in most instances the buyer is going to go ahead and buy these items on a credit card, pay a lot higher interest rate than the interest rate on the loan. Be that as it may, right, the package loan is a loan defined as a loan which includes items of personal property like a refrigerator, a washer, and a dryer. Oh, there's a There's a new modern washer. I'm curious, how many of you have actually ever even seen one of those, much less used them? I remember when I was a kid, my grandmother and then my mother had a washing machine just like that with the that wringer on there. That's how you got the water out of the clothes. Next on our hit parade is an open-end loan. A credit card is an open-end loan. It's unsecured, it's not a real estate loan, but in a credit card you are able to borrow more money up to a certain limit. You don't have to max out the loan every time you use your credit card. So in real estate, these home equity lines of credit are open-end loans. Some of you may have a home equity line of credit on your home where the bank agrees, okay, we're going to put a mortgage on your property, and it's the amount of $100,000 or $200,000, right? And you don't have to borrow money against it, but you can, and that loan balance goes up and down. Actually, I had a home equity line of credit on my home for years. I never used it. So just recently, we wound up just telling the bank we didn't want it anymore, and we got it satisfied. But it is a lien on the property. And typically, these loans have adjustable rate mortgages. So the interest rates will go up and down over a period of time. The next one is a construction loan, also called an interim loan, interim financing. Builders don't want to pay principal during the period of construction. You can see why. So construction loans typically are paid interest only. And it's called an interim loan because it's for the period in between, if you would, the time the construction starts and you find a buyer for the property to put the 30-year permanent financing on that property. So construction loans are interim loans. And the way the bank works with these construction loans is they don't give the lender, let's say, a $500,000 to build this $500,000 house. They will advance the money to the builder in a series of draws so that as construction proceeds, they go out and inspect the property to make sure it's done in a proper fashion, and then they'll give the builder that draw. The next one is called the takeout loan. I'm going to go to the bank and take out a loan. That may be where the term comes from. It could also come from the idea that this 30-year permanent financing, and that's what the takeout loan is the way that the builder's construction loan gets paid off or taken out. So the takeout loan is generally the 30-year fixed rate or 15-year fixed rate or adjustable rate financing that a buyer puts on the property to pay off the construction loan. Now, sometimes what happens is, and let's go back to the construction loan, sometimes we have a builder who's got a construction loan for a year. Remember, probably paying interest only. And usually, hopefully, they'll find a buyer before the end of that year. But what happens if they don't find a buyer within that year? The bank wants that construction loan to be paid off. So what happens is the builder, not having the funds to pay that bank off, goes to the bank and says, look, I've made my payments of interest only on time. Why don't you lend me the money to pay off that construction loan, and this new loan will be until I find a buyer. That's called a gap loan, also called a bridge loan or a swing loan. So a gap loan is a loan which fills some sort of a gap. The first example there was the one with the construction loan. Another one is where you have a buyer who wants to buy a house and needs money for the down payment. But to do that, they need to sell a property that they already have. And let's presume that property is on the market, but it hasn't closed yet. So what the buyer might do is go to their bank and say, look, will you lend me some money on this house that I'm selling so that I can have the down payment on the house that I want to buy and tie that up right now. That is also an example of a gap loan, swing loan, or bridge loan. The next is called a reverse annuity loan or just a reverse mortgage. In a reverse mortgage, the lender actually makes payments to the borrower. Now, these are reserved for people who are 62 or older. The idea being that people have oftentimes built up a lot of equity, maybe the property is free and clear, and these folks need some additional money to make ends meet during their retirement, so they can go to the lender and arrange a reverse payment or reverse mortgage. The term annuity, by the way, simply means a reverse payment loan. A superior loan. A superior loan simply indicates position. A superior loan would be a loan in a higher priority position to some other loan. A first loan would always be superior to a second. A second would be superior to a third. Please keep in mind there's one lien which is always superior to others, and that is the real property tax lien. So even a first mortgage loan is inferior or junior to a property tax lien. So the next one is called a junior loan, and a junior loan is, as it implies, is a loan which is in lower position, subordinate position to a superior loan. So a first mortgage loan is actually junior to property taxes. A second mortgage loan is junior to a first position mortgage loan. This next one is called a non-recourse loan. And you notice I've got a commercial property here, and a non-recourse loan is typically found in commercial properties, not in residential. It's simply a loan where the lender agrees not to look to the borrower personally to recover the money owed, but agrees to strictly look to the property. Now, in commercial transactions, usually the borrower is putting down a substantial amount or has a substantial equity in the property, and the property has income which could support paying the loan on the property. So, and oftentimes commercial borrowers are not just individuals, but are limited liability companies or corporations. So it would be harder to hold some of those folks personally liable. So a non-recourse loan is very simply a loan in which the lender has recourse only to the property, but does not have recourse to the borrowers personally. Non-recourse loan. So that does it for our discussion on the types of loans. In the next lesson, we're going to get into some of the loan clauses that are commonly found.